Inflation risk, stocks versus fixed income. Since inflation most significantly affects investments over the long term, it is important to examine the range of inflation-adjusted average returns for various asset classes over a long-term period. Inflation, the rise of prices, erodes each dollar you earn on your investments. By not considering the negative impact inflation has on investment returns, you could run the risk of overestimating your future purchasing power. This image illustrates the best and worst average inflation-adjusted returns over 20-year rolling periods for small and large stocks, government bonds, and treasury bills. Rolling period returns are a series of overlapping, contiguous periods of returns. When examining 20-year rolling periods of returns for annual data that starts in 1926, the first rolling period is 1926 to 1945. The second rolling period is 1927 to 1946, the third period 1928 to 47, etc. At their best, fixed income asset classes have experienced very modest 20-year real inflation-adjusted returns, 2.9% for treasury bills and 8.6% for government bonds. Historically, there have been periods where such assets have shown negative returns over 20 years after accounting for inflation. Stocks, however, have consistently exhibited positive real returns over 20-year periods. By investing in large or small stocks, you would have been better equipped to avoid losing purchasing power over the long run. Government bonds and treasury bills are guaranteed by the full faith and credit of the U.S. government as to the timely payment of principal and interest, while stocks are not guaranteed and have been more volatile than other asset classes. Furthermore, small stocks are more volatile than large stocks and are subject to significant price fluctuations, business risks, and are thinly traded. Some disclosures about the data. Small stocks are represented by the Ibbotson Small Company Stock Index. Large stocks are represented by the Ibbotson Large Company Stock Index. Government bonds by the 20-year U.S. government bond. Treasury bills by the 30-day U.S. Treasury bill. And inflation by the Consumer Price Index. An investment cannot be made directly in an index. Returns are compound annual returns. The data assumes reinvestment of income and does not account for taxes or transaction costs.